Hello and welcome to HYCM's webinar, the FX Week Ahead. My name is Giles Coughlin and I'm a currency analyst at forexlive.com, and I'm going to be helping us navigate the markets for the coming week. We're going to be highlighting some of the major issues. We're going to be looking at some of the big data points, and hopefully you're going to be in a much better position to navigate your own trading and yourself through the markets in the coming week. Just give folks a moment to join. Just check who's coming in. Just giving people a opportunity to, let's see who's here. Hi Gabriel, hi Ham again, welcome back. And you Mo, hi Malcolm, Oswald, Raj. Nice to have you with us. I hope you can hear okay. If you've got any problems, yeah, hi Oswald, hi Mo. Thanks for, don't forget you can use the question tab and you can use the chat tab as well at the back. Are you all hearing me okay? Hi, Malcolm. Yeah, that's good. Okay, I think everyone, if you've got any problems during the webinar, just use those tabs to let me know. Last week I made a mistake and I wasn't showing the main screen, but thankfully it was flagged up. So thanks for that, guys. But we're showing the main screen this time. So welcome to the week ahead. Once again, it's a really action-packed week. The theme of the markets as of late has been geopolitical concerns really influencing the financial markets in a major way. And unsurprisingly, it's pretty much exactly the same this week. So we're going to just go through some of the big moves and the big geopolitical events. Now, the first event, the first situation to make you aware of is the Turkish lira. It's been very widely reported that the lira was losing a lot of value. That, as we've mentioned before, it was because of the Turkish Prime Minister was a very charismatic gentleman, and he was kind of erring away from normal financial procedure. And Turkey itself is run at a current account deficit, which means they have to actually borrow money to function. And the weakening of the lira against the US dollar was making it very hard to repay the loans that Turkey has taken out. The financial markets were concerned, and instead of raising interest rates, which is what should have happened, Erdogan's son-in-law was in charge of the central bank, and the central bank had held back from raising interest rates, which is what they should have done. Now, last week, the Turkish central bank did increase interest rates. Now, they flagged this up the week before, and markets could see that there was a change afoot. Now, this is what happened on the charts. We'll look at the Turkish lira. So we'll just go over here to the Turkish lira. Now, this was the raised interest rates from Turkey. You can see the reaction was extreme, and the reason the reaction was so extreme was because of the increase. Now, the increase was from 17.75% to 24%, a whopping interest rate rise. Now, it was widely anticipated that only interest rise of 3% would, satisfy the markets, and so the central bank has really exceeded market expectations. And that is a whopping interest rate rise of sort of 6.25% in one go. So that's really extreme. So you can see the market's reaction here. You can see the Turkish lira was strengthening, and it's US dollar Turkish lira pair that we've got. So a strong Turkish lira is a bearish US dollar Turkish lira. And this was the reaction. Now, we can see the prices retracing back here. Now, I'm not suggesting you trade this pair, and the reason I don't suggest you trade this pair is because the spread tends to be very wide on this pair. However, I would look at HYCM spread, and that is quite reasonable. That is not a bad spread at all. So if you were trading this, again, this is not trading advice, but if you were trading this, a simple way would be to draw your fibs from the news announcement. You then have a nice confluence of a few factors. You have a support turn resistance level that's coinciding with the 61.8% fib retracement and the 200 moving average. So if someone was to trade that level. I'm not suggesting you should, but a very simple trade would be entering a sell there, and you put your stop just above the 200 moving average. Now make allowance for the spread in this, because the spread can be quite large. But that's a way of defining, limiting your risk, and then you can make a play down to these kind of lows here. So you can see, look, it's a relatively limited risk, allow for the spread, and that's a sensible place to kind of trade. Again, that's not a trading advice. I'm not saying you should do that. I'm just saying that's the kind of scenario that you want to look for when those multiple factors are coming together. Big interest rate hike, big surprise by the markets. A key place to trade from. Just makes sense from a technical and a fundamental perspective. Now, the next thing to look at, we've looked at the US dollar, Turkish lira. Next thing to look at is the Russian rate rise. Now, the Central Bank of Russia, they increased their rate hikes. Now, look, the reason these are significant, these moves, is twofold. It's not just, trading these currency pairs at all. It's because of the impact that these pairs have. Now, the Turkish lira, when that was losing value, that was affecting the euro. And the reason it was affecting the euro is because a lot of European central banks had lent money to Turkey. And of course, if Turkey can't pay back the loans, then the European banks rather are going to have bad debt that they can't service or finance. So that's why the Turkish lira crisis began to affect the euro, and that's why some safe haven currencies were being bid as well. So with the ruble and the lira now having their interest rates increased, that's given the markets a little bit of confidence. Okay, this situation is under control. Erdogan might be a charismatic leader. He may be prone to do, unconventional things. But hang on, the central bank is independent. Erdogan himself outlined that before, and it was quite fascinating to hear Erdogan's comments just before the central bank's increase. I was following that scenario at the time. It was really fascinating to see the interplay between the two. But the bottom line and the takeaway for you guys to really take away, and girls, is that the markets are beginning to sense a calm. So there was a sense of calm coming into the markets at the end of last week, a sense of, okay, this can be more risk-on environment. The euro was increasing, the pound was increasing, some of the commodity currencies were increasing in value. There was a general sort of calm. Now, the question for this week is that going to carry on, or is it not going to carry on? And of course, that brings us very nicely to the issue that will stop a sense of calm coming into the markets. And that is, of course, our good old friend, Mr. President Trump. And of course, I'm talking here about the US-China trade war. Now, this has been going to and fro, a little bit like a soap opera. Now, if you've been following this, you'll be following all the ins and the outs. Now, the latest installment of the soap opera is last Friday, President Trump, he announced that, and he told the aides, let's proceed with the $200 billion of additional tariffs on China. Okay, so this is what he said. He said the Wall Street Journal has it wrong. We're under no pressure to make a deal with China. They're under pressure to make a deal with us. Our markets are surging. Theirs are collapsing. We will soon be taking in billions of tariffs and making products at home. If we meet, we meet. But the speculation was because the US and China were going to have some high-level trade talks. The speculation was, oh, that's fine. The trade tariffs are going to filter into the background and they're going to make peace and it's all going to be okay. But President Trump says, no, that is not the case. The tariffs are still set to go. And recently, so today, he said, this is a tweet that he said today. He said, tariffs have put the US in a very strong bargaining position with billions of dollars and jobs flowing into our country. And yet cost increases have thus far been almost unnoticeable. If countries will not make fair deals with us, they will be tariffed. Now, is this President Trump announcing in advance, which he is prone to do on Twitter? He does announce things in advance by the way he handles his Twitter feed. So if you're not following Donald Trump's tweets, I suggest you do so, because he does give away financial information. So you can go to Twitter, find out how to follow his tweets. I have them popping up on my phone. And in fact, this situation here on the Friday, I got the Friday tweet, and I was able to enter a short Aussie yen because I thought, you know what, I could see Donald Trump making a tweet, and I had my squawk off, and I just turned it all back on. And I just thought, because I could see him making a tweet, he'd been making tweets on Fridays about tariffs recently, and I just thought, oh, I wonder if he'll do the same again. And he did do the same again. It was really quite interesting. So this was, the Wall Street Journal article over the weekend. Trump to announce new tariffs on 200 billion in Chinese imports. This is the expectation. So this is where we are with the markets. Now, of course, if Trump does, announce these tariffs, you have to look at the detail, because there was some talk of him only implementing 10% of the tariffs, and then saying there's a future date where the other 200 billion will be implemented. So you've got to look at the details carefully, because the market is sort of expecting a 25% tariff level to start off with. So you have to look at the detail. Don't just jump in the moment tariffs are announced. But this scenario is sort of bubbling away in the background, and this will affect the Australian dollar, because the Australian dollar has a very close relationship with China because of the exports that go from Australia to China. It works out to be about a third of Australia's GDP is affected by its export levels to China. So what's bad for China is bad for Australia. So just have those, that sort of correlation in your mind, and that's why when the announcement came out, I did short the Australian Japanese yen pair, and I'll just show you how I played that. Just again, not advice. When it's gone now, you can't trade it anyway, but just for your education. So this is what happened, and again, I'll say this is HYCM's account that I use, and I'm using this for your educational purposes. Now let's have a look. Okay. Now, if you're looking at the Aussie Japanese yen pair here, now it was on Friday when you got that was Trump's tweet. It was here. Now, I got in on that very quickly just after I show you one. With these kind of big announcements, you really want to be in, within the first 5-minute candle if it's something worth holding. I was in after about a couple of minutes. I got it a bit late, but what I did, I'll just show you. I hope this will be interesting for you. So it takes a while to get over to it. It's the Friday. There, okay, we're nearly there. There we go. That was the 1-minute candle. Okay, that was Trump announcing the tariffs. I got in here at about. Yeah, it was 80.28. That's where I got in. I sold from there, put my stops above the high. As soon as I was testing these lows here, I brought my stop to break even. I thought, let's see how far this goes. And I didn't want to hold any risk over the weekend, and I wanted to get as much risk out of the trade as I could. But that's the follow through that I was looking for on Friday didn't happen. We've had this retrace now, but you see, tariffs are still in the background. If tariffs are impacted, you get a double whammy on the Aussie yen, because the Australian dollar will be hit because tariffs are on China, and the Japanese yen will be bid because that is one of the go-to safe haven currencies. Now, if you look where price is, where is price? Look, it's sat just below the 200 moving average. You can see the 200 moving average expected here, here, here. You can go to look at the support and resistance webinar that I've done for HYCM. It's under their training tools. It's my name. You can see it's there. I'll show you how to use it in a bit more detail. But that would be a very logical place where you could define, limit your risk, and also make a play for some more downside. Again, not trading advice. It's simply for your education. And the pair that I'll show you a trade that I took recently just for your education again. Okay, so let's go. Let's look at the next issue. Now, the next issue is NAFTA. Now, the NAFTA scenario is, again, it's been another soap opera. Will they make a deal? Won't they make a deal? It goes back and forward, and we're in the middle of a back and forward at the moment. Now, we'll look at the US dollar Canadian dollar pair. And basically, if a deal is made, you can expect to see these lows being touched. If a deal isn't made, you can expect to see these highs being touched pretty much instantly on the announcement. Okay, so if there is a deal, we're starting to look, okay, realistically, we're starting to look for a move down to here. And if a deal isn't made with NAFTA, then we're starting to look for a play up to these highs. So this is a really key time for the US dollar Canadian dollar pair, and you want to sort of be trading this pair in relation to what happens with the NAFTA deal. Okay, so keep following that information. There was meant to be some talks today, but they haven't gone on. Keep following, keep up with the data. Positive sentiment is going to be bullish for the Canadian dollar on the NAFTA deal getting done. Markets are quite concerned that the NAFTA deal will actually get done, so bear that in mind. Brexit, Brexit, Brexit. Now this again is a constant drama. It's actually I'm running almost out of time. There's so many issues, geopolitical issues going on at the moment. Now the situation with Brexit is that last week people were generally sensing that a Brexit deal is going to get done. Okay, there was a little bit of US dollar weakness. And on top of that, there was a general thought that, Theresa May is going to be able to stay in position, and that the Brexit negotiations with the EU and Britain are going to go sufficiently well that market participants were starting to price in, a more favourable Brexit outcome. And I would say that's where the market is at the moment. They're kind of thinking the Brexit deal is going to get done. Now, I'll show you something that's adding to a little bit of that pound US dollar retracement. And it's here, it's from the COT report. Now, the best way to use the COT report is to look at fundamental shifts and look at positioning which doesn't represent the fundamental shift. And an instance here of one to keep our eye on is the pound shorts. Now, these are the levels of pound shorts that have been going on here. That's the baseline level. We're now at minus 61,000 contracts, minus 70,000 contracts. And the interesting factor with the shorts on the pound is that a lot of those contracts that are short are now starting to feel some pain because the pound was the strongest currency last week. So if you look at the pound US dollar, looking at the pound US dollar, what you will see is that the pound was increasing for a lot of last week. We're now up against the 100 moving average, and we're starting to look like we could break. And from there, the next target is going to be 200 moving average, and these resistance levels from these daily highs somewhere around there. So what exactly happens with the price is uncertain, but you can see there's a more bullish sentiment. Now, the problem with the Brexit is that it's really, really prone to headlines, and there's a lot of political details going on. We may have time to get on with that during the webinar, but for now, just to be aware that the pound is very headline sensitive. Now, a trade I took, again, for your guys' education, was a trade here on the pound Australian dollar pair. Now, what you want to do in trading is you want to pair a stronger currency against a weaker currency. Now, because of the trade negotiations going on with US and China, I knew that the Australian dollar was likely to be weak. Okay, so the weaker currency pair, the Australian dollar. Now, there was a bit more confidence in Theresa May and the Brexit deal getting done, and that looked like the likely scenario at the moment. So the sentiment was a bullish pound and bearish Australian dollar. So then you want to look for logical places to go long pound Australian dollar. And a trade I took was one here when you had the reaction of the 50 moving average. I entered a long here and I had my stop below the low. I had two positions. My first position I took off around the highs here because that was like a daily kind of resistance level. Then I bought my second position to break even here, which you can see is just running slightly, running in profit there. I'm just going to leave that, and ultimate target would be this high up here. So you can see you want to define and limit your risk as much as possible. And on another account that I have, I got an even better entry when I traded the 15-minute chart, when I saw the bounce off this 200 moving average. I entered in just around there. I put my stop just below there, 4 or 5 points, and took my first position off up at the ties. And then I've just put my other position at break even, and I'm not going to think about it again. And you want to try and get the odd flyer that really helps pick up your account. So that's just, I thought that's a good one for you guys to look at. And the same here, I'll just leave this here all week. Once I close this platform, I don't look at it again. So we'll see what happens. And there's the US dollar Turkish lira. You can see already that there was, even while we're doing this live, you can see the reaction to this kind of level. It's being, viewed at by market participants all over the world. So whether it's a winner or a loser, in one sense, it's, you can just see the reaction. So it's helpful for you to get that idea. Although, very careful about trading this pair. It's a very volatile pair. It's got a wide spread, and it's not for beginners. However, I more wanted to use it to illustrate, the kind of techniques you would use on any currency pair. Now let's go ahead to the week ahead. So we're going to go to the calendar, and looking ahead, pretty quiet day today on Monday. Tuesday, we got the Reserve Bank of Australia, their meeting minutes. That's going to be interesting to see what's going on out of Australia. Their domestic story has been pretty uninspiring, really, at the moment. There's been some good Australian jobs growth, but the domestic banks have been increasing mortgage rates. So it's going to be interesting to see whether the Reserve Bank of Australia has got any concerns about that filtering through. And if it does, will that affect their likelihood of increasing interest rates? At the moment, they're saying it's more likely they hike up than down. Their interest rates are due to be increased in about 12 months' time, sometime in 2019 towards the end. So the market's going to be looking at, what's the Reserve Bank of Australia thinking? How are they feeling? Do they still think that's the case? Do they still not think that's the case? So the meeting minutes are really important for you to read and to pay attention to. The next interesting event on Tuesday is European Central Bank's President Draghi's speech. Now that is going to be interesting because the ECB is on a lower for longer rate hike scenario. They're not going to hike their rates, they've said, until summer 2019. They're slowly withdrawing their quantitative easing program, due to be ending in December. So there was some chatter after the last ECB rate meeting that some of the members of the board had thought about indicating to the market that there's downside risk factors ahead. So let's see what Draghi says, and that will give some indication of where the ECB is thinking about, and that the markets are trying to look at, when are they going to hike their rates? Is it going to be summer 2019? Could they do it before? Could they do it later? The market's always trying to see what's happening next. So tune into Draghi's speech on Tuesday. The next interesting scenario is it's going to be Wednesday. You've got the Bank of Japan's monetary policy statement. Now, in one sense, nothing is expected here of significance, but it's worth just paying attention to and just being aware of if you're trading the Japanese yen into that meeting. Just you want to be moving your stops, closing your positions, because the Bank of Japan has been sort of secretly, as it were, or very subtly decreasing their quantitative easing program. And if there's any hint of policy change, you're going to see some Japanese yen strength, some encouragement about the GDP numbers, which have been quite good. It's one to keep an eye on. It's one that it probably be a non-event, but just keep an eye on, have on your radar. We then have some CPI data coming out for the pound. Now, what's going to be driving the pound is the Brexit negotiations. Make no mistake of that. So keep that firmly in your mind. You want to follow the Brexit negotiations more than the kind of data, in a sense. However, be aware of the data. The CPI data is coming out, and Now, the Bank of England has expressed that there may be some softer inflation because the higher inflation features that had led to some higher inflation for the Bank of England recently. You can see, look, some of the higher levels they've been: December 3.1, January 3, February 3, then 2.7, 2.5, 2.4. So they're expecting it to be softer. But as long as it's kind of above the 2%, that still leaves scope for the Bank of England to increase interest rates in the first half of 2019 if the Brexit risks are taken off the table. So you've got to factor that into the jigsaw puzzle. If the Brexit deal gets done, and then all of a sudden these figures are going to become really important, and if they're good, my opinion, good is going to be above 2%. That's going to mean, okay, interest rate hike coming first half of 2019, very likely. So that would be appreciative, bullish for the pound. So you just got to keep that in your mind. Now let's have a look what's coming up. What's next? Now, what's coming up next is GDP for New Zealand. Now, again, interesting scenario. Now, it's 0.8% expected. Now, that's a bit better than 0.5% previous. Now, Governor Orr has been saying about the New Zealand dollar, he's been saying, look, one of our big concerns is business confidence. So his concern is business confidence. There was some forward guidance he gave to the market. We're less keen to raise interest rates, and the market, responded and sold the New Zealand dollar. And this will be viewed, because he might be concerned about business confidence, but if the reality is that GDP is quite good, then it doesn't matter. If you might be feeling not very confident, but things are going well. So the market will be interpreting this to see what's actually going on. So 0.8% is quite a good expectation. In a sense, you could, one way to explain, to kind of guide strategies and how to trade. There is a specific technique where you can look to buy currencies into an event, and this will be a good example because 0.5% but 0.8% expected. So the New Zealand dollar would typically appreciate in this scenario into the event. Now, what happens at the event is a different matter, but of course, what you have to remember here, and this is the real factor that you have to remember and keep at the front of your mind, is that if the Chinese tariffs come into place, then the New Zealand dollar and the Australian dollar are going to be affected as commodity currencies, and they're going to lose their value. So you've got to hold different factors together with this. Thursday, there is the SMB's monetary policy assessment. Now, that is worth looking at. And the reason that's worth looking at is because the Swiss franc has been the strongest currency in the second half of 2018 so far. You can see how strong it's been. And the reason the Swiss franc has been so strong is because there's been a lot of geopolitical concerns. And the Swiss franc is bought when the market is concerned about risk. So this is a risk-off currency. You buy the Swiss franc. It's one of the best safe havens you can. And obviously, with problems being in Europe and potentially between US, China, and the Asian situation, you've had a strong appreciating Swiss franc. Now, the Swiss National Bank has a stated policy of intervening in their currency when when the Swiss franc gets too strong. Now, these are the sight deposits that came out today. That came out, the most recent sight deposits that have come. Now, the most recent sight deposits indicate that they haven't really been intervening in their currency pair yet. So on Thursday, they will meet. And the question is, you can see, so there's the US dollar Turkish lira reaction. You can see that coming off quite strongly to the downside. Apologies for the notifications. I need to work out how to how to close these off at some stage. Where was I? I was on, Euro Swiss franc. Now, look, let's have a look. Let's zoom out and have a look at the Euro Swiss franc pair. Oh, I can't because of the limitations on this time frame. It hasn't got the full data here. Let's just have a look. Has it? No, it's not. Not to worry, I can explain the situation fairly simply. 1.2 is a significant level with the euro Swiss franc, and the Swiss National Bank don't want to see a low euro Swiss franc because that affects all the exports that come out of Switzerland. They want to see euro Swiss franc that's higher, 1.2 and beyond. So they will intervene in their currency. So the question is, when will they intervene? Okay, we're approaching yearly lows, I think, for them now. Although I can't confirm that because I can't see the whole line, but you have to check that out for yourself. So at some point, they're going to intervene. How? When? What will they do? So the thing to look at is when they give their rate statement, do they change their language? So their latest rate statement says that the franc is highly valued. But if they say they shift back to the previously significantly overvalued phrase or anything more substantial, that will mean the market will think, oh, hang on, the Swiss National Bank might act here to intervene and increase their they might intervene to keep the euro Swiss franc pair bid, so they might intervene in that way. So you've got to look on Thursday and see what they say. Okay, and my suspicion is that it's got to start sometime. So you could think, okay, will this be the time? Could they start intervening now? Or they might think, well, hang on, we don't know what's going to happen with the US-China trade war. If that really kicks off, then there's going to be a lot more Swiss franc being bought. So these are the kind of issues they've got to assess and think about. But that's one for you definitely to look at. And then finally, the final issue to look at is the data coming out on Friday for Canada. Now, the Bank of Canada, obviously, we've discussed NAFTA deals already, and that is going to be what's driving the Canadian dollar in the major sense. So that's the big picture to keep in front of your mind. But the CPI data will be important as well. Now, it's 1.4% versus 1.6% previously. If we see a beat of that CPI data, then at the moment, the Bank of Canada is virtually expected, 80% chances of increasing their rates at their next rate statement in October. So that's what's expected. But obviously, the CPI data out here, it depends what it is. Like if that's really high, then it might look like, okay, they might be hiking rates twice. That's the kind of situation the market's looking at, trying to interpret in advance. And conversely, if that's a real miss, it's 1.1% or something like that, then okay, it might be just one rate hike in October, or it may not be a rate hike in October if NAFTA doesn't get done. So if NAFTA's still not done and the October rate hike still comes around, then that's another scenario that you have to think about. So in trading, you're balancing all these different pictures and all these different puzzle pieces together to try to get a sense of where price is going, and then you're using good support and resistance levels to define and limit your risk. So folks, that is what we're looking at for the coming week. I hope that you've enjoyed this webinar. There will be another webinar once again at the same time and the same place. It will be on the 24th of September, and it will be here again with me. So I hope you have a really good week. Thank you very much for listening to this webinar. Thank you for, hang on, I've got some questions here. Let's just go have a look. Should I go long on US dollar, Japanese yen? Okay, Ham, obviously I can't offer you trading advice. My job here is to educate you, not to tell you what to do with your trading. And the reason that is, Ham, it's not just me being mean. It's because it's very important as a trader to make your own decisions. So what this analysis is trying to do is to encourage you how to make your own decisions and the kind of factors you want to be thinking about. This is an educational webinar. It's not a signal service. How do I know whether to go long or short from Wall Street Journal? Or like Donald tweets? Yeah, Ham, I understand. Ham, the way you become familiar and the way you know what to do when you see certain tweets come out is by immersing yourself in the story of the market. When you know what the market is focusing on, then you get to see the data that's significant, and it comes through time and experience. That's the ways that you get that. Price can't bounce off of averages, only visual. Not sure what you meant by that, Oswald. If you want to put another question in to clarify that. How much dollars you lost in trading and starting the video? All right, Han. Maybe another time for that. Enjoyed that. A real professional insight with no fluff. Yeah, thanks, Malcolm. Thank you for your webinar. Yeah, Mo, I like your sentiment webinar. Can you please guide me to improve in this part? Mo, the way you improve in understanding sentiment is exactly what I said before. You spend time understanding what the market is focusing on. And when you understand what the market is focusing on, you get to see the nuances within the market. And it's like, how do you know any story? You know any story by becoming familiar with it, reading it, researching it. And that's the way that you develop these skills. And reality is that they're not hard to actually develop, but they do take time. Okay, fine, folks. Okay. Can you share me your email, please? Mo, you need to contact HYCM Fibonacci. Now, Raj, I've explained that a little bit in my support and resistance webinar, which is available for HYCM. And if you guys ever want to see anything, if you guys want to, if you guys want some specific topic, then please let us know in the questions in the chat, okay? And please let HYCM know, and then we can arrange to do specific topics that you guys really want. If you wanted to have a seminar on how to use the Fibonacci, right, that can all be done, okay? So it's really over to you guys sometimes just to contact HYCM support, let them know, did you like the webinar? What would you like extra? What kind of topics are you interested in? Just keep it coming. Okay, guys, thank you for today. Thank you for all the comments. Thank you for the questions. I hope I've been able to open some of them. I'm sorry I haven't been able to answer all of them, but I hope you have a really good week, and I will be back again next week, same time, same place. Thanks, guys. Take care now. Bye.